Why indicators matter. The stock market. It's the big leagues, people. It's exciting. It's full of action, non-stop. Big money can be made, serious money. But let me tell you, it's not a game for amateurs. You need tools. You need an edge. You gotta know what you're doing. That's where we start. Are you ready? Booyah! Why indicators, you ask? Think about it. The market goes up, the market goes down, sometimes sideways. It can be a wild ride, a real roller coaster. Indicators are like your market GPS, your roadmap. They help you see the road ahead, or at least the recent past. Are we in an uptrend? Is a storm brewing? Indicators give you clues. They help you make smarter decisions, not just wild guesses. We're not gamblers here, we're traders. So what are these magical things I keep talking about? Trade indicators are basically mathematical calculations. Sounds fancy, right? But they're based on simple things. A stock's price. How much of it is being traded? That's volume. They take this raw data, they crunch the numbers, and they turn it into visual signals. Lines on a chart, oscillators, things you can see. Easy to understand, well, mostly. We'll get to that. Now listen up, this is important. Crucial. Indicators are not a crystal ball. I repeat, not a crystal ball. They don't predict the future with 100% certainty. Nobody can do that. If they say they can, run away. But they are super helpful, incredibly useful. They show you probabilities. They highlight potential turning points. They help you manage risk. That's why we use them. They give you an informed opinion, not a guarantee. Let's get specific, folks. Let's dive deeper. Indicators analyze past market action, what happened before. They look at price movements, up, down, all around. They look at trading volume, how many shares are flying. This history, this data, it gives us insights, valuable insights. It helps us understand market psychology, mass psychology. What are other traders thinking? What are they doing? Are they buying like crazy or running for the exits? Their main job, their purpose in life, to identify trends. Is the stock in a glorious uptrend, making higher highs and higher lows, music to my ears? Or is it stuck in a nasty downtrend, lower lows, lower highs, yikes? They also help spot momentum. Is the buying pressure strong, or is selling taking over the game? This is crucial stuff, people, absolutely essential. Knowing the trend and momentum is half the battle. Investors, the smart ones anyway, look at these signals. They check their indicators. They do their homework. Before they hit that glorious buy button. Before they scream sell, sell, sell. Why? Because indicators can suggest good entry points, when to get in. They can also tell you when it might be time to take profits, or just as importantly, when to cut your losses. Protect your precious capital. That's rule number one. Different indicators tell different stories. It's true. Some are great for spotting long-term trends, the big picture. Others are better for short-term swings, quick in, quick out. The key, the absolute key, is to understand what each indicator is telling you and how it fits your personal trading style, your strategy. There's no one-size-fits-all magic indicator. You have to find what works for you and test it. Don't just follow blindly. Think. All right, so first up on my list, moving averages, MA. Simple, elegant, yet incredibly powerful. Don't underestimate them. A moving average smooths out all that noisy price data. It shows you the average price over a set period, like 50 days for an intermediate trend, or 200 days for the long haul. It helps you see the underlying trend. Clearly, price above the MA, that's bullish, baby. Price below the MA, that's bearish. Caution. Next, let's talk about the Relative Strength Index, RSI. This one's a momentum oscillator. It measures the speed and change of price movements. It tells you if a stock is getting ahead of itself. It ranges from 0 to 100. Simple scale. If the RSI goes above 70, the stock might be overbought. Too hot, it might be due for a pullback, a breather. If it's below 30, it might be oversold, a potential bargain. Time to go shopping? RSI gives you clues. Booyah! Then there's the MACD, Moving Average Convergence Divergence. Sounds complicated, I know, but it's a workhorse. It shows the relationship between two different moving averages of a stock's price. You get a MACD line, you get a signal line, and a histogram. When the MACD line crosses above that signal line, that's often a bullish signal, a potential buy. When it crosses below, watch out. Could be time to sell or short. It helps confirm trends and momentum. Very useful. So how do these indicators help you make better decisions? Imagine this. A stock is trading above its 50-day MA. Good sign. The RSI is climbing but not yet overbought, say, around 60. Another good sign. And the MACD just gave a bullish crossover. Ding, 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 that's multiple confirmations, people. Multiple green lights. That's what we look for. It stacks the odds in your favor. It gives you more confidence in your trade. It's not a guarantee, but it's a heck of a lot better than guessing. Hold up, don't trade blindly. Now a big warning, a huge one. Listen carefully. Indicators are not foolproof. They are not infallible. They can and they will give false signals sometimes. Whipsaws. The market can fake you out. It loves to do that. One indicator might scream, buy. Another might whisper, wait. What do you do then? It can be tricky, confusing. That's why you need more than just one trick up your sleeve. Don't put all your faith in one line on a chart. Remember, indicators are primarily backward-looking. They use historical price and volume data, what already happened. The future can and often will be different. Unexpected news can hit the market like a thunderbolt. A bad earnings report, a new competitor, a global event. An indicator won't see that specific news coming. It's reactive to price changes caused by news, not predictive of the news itself. So don't rely on them alone, ever, please. Smart investors, the ones who make consistent money, use a toolbox. Indicators are one important tool in that box, but just one. Fundamental analysis is another crucial tool. What does the company actually do? Is it a good business? Are its earnings growing? What about its debt levels, its management? News events matter. Industry trends matter. The overall economy matters. You need the whole picture, the full story. Not just a few squiggly lines on a chart. Do your homework. So what's the bottom line here, folks? Indicators are fantastic. They are valuable. Learn them. Understand how they work, what they measure, their strengths, their weaknesses, but use them wisely as part of a broader strategy. Combine them with other research, with common sense. Never stop learning. The market is always evolving, always changing. You need to adapt. You need to stay sharp. Be cautious. Be smart. And maybe, just maybe, you'll make some serious Kramer-style money. No mercy. Go, go, go.